Hello everyone, welcome to the BISP Solutions. Today we are going to discuss about balance sheet drivers. In the previous sessions, we have already discussed about what is custom financial planning, why we are doing that, and after that we have also discussed about the data forms, like how we prepare the data forms for inputting the data, and today we will be going to cover few more topics, that is balance sheet drivers, dimension and data form, and also discussing about the corresponding formulas, and after that we will discuss about the ratio accounts in account dimension members and their corresponding formulas and data form. So let's get started with that. Before starting anything, generally we are covering like why we are doing that. So today we are going to cover the balance sheet drivers, or we can see the financial drivers itself. So what are that? So financial drivers, we can say that drivers are the variables that influence or determine your financial results, such as sales volume, price, customer retention, productivity, or quality. And by using drivers, you can simplify your forecast model and make it more responsive to changes in your business environment. So there are various drivers. Let me show you in my application, which we are using for calculation purpose. So here you can see that in my statistics column, there are capital expenditures, miscellaneous drivers, expense drivers, and balance sheet drivers. Then after that, there are a few revenue drivers, expense planning. So first we will be discussing about the balance sheet drivers, and under that, I have further classified that into DSO, bad debts, days in inventory, prepaid, DPO, number of days, accrued payroll, expenses. So let's start it with DSO, like what is DSO and what is the actual use of that. So DSO means days sales outstanding. We can say a measure of the average number of days that it takes a company to collect payment for a sale. Or also we can say that days sales outstanding, DSO, is a measure of average number of days that it takes a company to collect payment for a sale. DSO is often determined on a monthly, quarterly, or annual basis. To compute DSO, divide the average accounts receivables during a given period by the total value of credit sales during the same period, and then we will multiply the result by the number of days in the period being measured. Days sales outstanding is an element of the cash conversion cycle and may also be referred to as days receivables or average collection period. You can more better understand by this what is the actual use of DSO. So DSO can tell us the amount of sales made during a specific time period. Like for every business, they just want to know that whatever the amount of sales they made during a specific time period. So with the help of DSO, generally we can identify that and how quickly our customers are paying. Every businessman wants this, that if they are selling the products on credit, so how quickly the customers pay their debts. So DSO will definitely help on that. And if your collections department is working well, this is also be identified with the help of DSO, and the average time it takes to collect on your invoices. We can also getting the average time, like in how much time we will be collecting our invoices, and then customer satisfaction, and if credit is being given to customers that are not credit worthy. So we can also identify the quality of the customers we have with the help of this. So in these cases, DSO will help us. And if we want to know like what is the formula for DSO, so we can see that DSO is calculated with the help of account receivables or the total credit sales because what we are identifying with the help of DSO, we are identifying the number of days, how much number of days we will be getting our payment from the creditors, right, or the from the people to whom we have sold the products on credit. So DSO is calculated with the help of account receivable divided by total credit sales into number of days. Okay, so we can also see that the given vital importance of cash flow in running a business. So it is in a company's best interest to collect its outstanding account receivables as quickly as possible. Companies can expect with relative certainty that they will be paid their outstanding receivables, but because of their time value of money principle, we all know about this. The time value of money principle applies where one wants to know the like how much time will be required for getting our payments, for getting our desired results. So time value of money principle will be applied everywhere in the business scenarios. So time spent waiting to be paid is money lost. So that said, the definition is of quickly depends on the business. In the financial industry, relatively long payment terms are common. In the agriculture and fuel industries, fast payments can be crucial, right? So in general terms, small business rely more heavily on steady cash flows than large diversified companies, right? So let's understand what is the like how we can apply the formula for of DSO in our application for calculating that. You can see that example. Let me expand this. Okay, so I'll be reading for you that let's consider a specific scenario for a company A. I'll be explaining you in the Excel. So let's consider a specific scenario for company A hygienic products provider. In a given period, the company recorded approximately $30,000 in credit sales. So they were sold the products for $30,000 and had 20,000 in account receivables that were collected within 40 days. So each and every information is given by the company, like how much days will be getting the collection, and let's calculate its days outstanding, days sales outstanding. So DSO will be calculated by 20,000 by 30,000 into 40, that is the number of days. So it will be 26.6 days. So this signifies that company A successfully recovers its dues within an average of 26.6 days, resulting in a DSO of 26.6 days. This achievement is remarkable. Why? Because a DSO below 45 days indicates a low DSO, reflecting the company's benefit from promptly paying customers and enjoying a stable cash flow. Like I'll be explaining you here. This is our company A, and suppose it sold the products on credit. So its credit sales are 8 lakh, and its account receivables among those are 40,000, and its number of days are 40. So how will be calculated the DSO? Account receivables divided by credit sales multiply by number of days. So it will be calculated 40,000 divided by 8 lakh multiply by 40. So it becomes 2. But if we use this formula similarly, this example, so it is saying that the company recorded approximately 30,000 in credit sales. Okay, so here the credit sales is 30,000 and had 20,000 in account receivables, and the number of days is 40 that were collected within 40 days. So that's why the number of days is 40 days. So in that case it becomes 20,000 by 30,000 multiply by 40. So you can see the DSO will be 26.67 and it is less than the limit, that is 45. So DSO is saying that if the limit if it becomes the less than the limit, that is 45, so it is a low DSO. And where it will be using, I'll definitely tell you that also. The achievement is remarkable because a DSO below 45 days indicates a low DSO, that reflecting the company's benefit, because we are getting the amount within less time which is prescribed. So the benefit from promptly paying customers and enjoying a stable cash flow. You can also understand with the help of this that days sales outstanding can be analyzed in a wide variety of ways. It suggests how efficient the company's collections department is and the degree to which the company is maintaining customer satisfaction. It also helps identify customers who are not credit worthy. So looking at the DSO value for a company for a single period can provide a good benchmark for quickly assessing the company's cash flow. However, trends in DSO over time are much more useful. They can act as an early warning sign of trouble. You can also see that good and bad DSO numbers. If a company's DSO is increasing, so it's a warning sign that something is wrong. Customer satisfaction might be declining, or the sales people may be offering longer terms of payment to derive increased sales. Perhaps the company may be allowing customers with poor credit to make purchases on credit, right? So a sharp increase in DSO can cause a company serious cash flow problems. So this is the reason why we want that DSO should be like not more than 45 days. If a company's ability to make its own payments in a timely fashion is disrupted, it may be forced to make drastic changes. So it is help there. Now let's see how it works in the application. So I've already applied a formula in DSO. You can see, click on edit and go to the member formula. Let me refresh this. I have applied the formula for each and every drivers so that it will be helpful in calculating the exact numbers. You can see that DSO is 11105 divided by contract revenue by number of days, multiply by number of days. Now I'll be explaining you what is that 11105. You can see that 11105 is account receivable, which is our formula says account receivable divided by credit sales multiply by number of days. So it is calculated with the help of that. Here the credit sales, apart from credit sales, we have taken the contract revenue, because this is we are dealing with the uh, builders. That's why for credit sales, in place of credit sales, here I took the contract revenue, uh, and the number of days. Okay, so in this way it will automatically calculate it, and I'll definitely show you in the data form itself. I have created a data form for this. You can see I have created the balance sheet drivers plan, and I'll show you the layout of this. I've used plan because I'm calculating for the financial year 24, and here I selected the level 0 dimensions, and in the rows I selected all the balance sheet level 0 descendants of the balance sheet drivers, and in the columns I have taken the level 0 descendants of the year total, so that it will be calculated for the whole year. Now let's check the preview. Right now I have not provided the numbers, but when I put the number of days, then it will automatically calculate the rest of the members, because I have already applied the member formula in each of the cases, whether it is a DSO, bad debts, and days in inventory, then prepaid, DPO, each and everything. So just I have to provide the number of days, and rest information I have already entered in with the help of other data forms, so it will be calculated automatically. I will show you with the help of a smart view. Now let's quickly select the relevant information for all these accounts. Here I want the account receivables. Then I want the contract revenue. And number of days. Now let's put the values here. 3 lakh and number of days is 40. So it is the contract revenue is calculated, and here we'll be taking 80,000, submit data and refresh, and let's provide this 40. You can see that I have applied the formula in the days sales outstanding, so it is automatically calculated as 10. I have not entered any value here, but I've just provided the value in the contract revenue, in the account receivables, and the number of days. So it is automatically calculated as 10. Similarly, I can apply for other members as well, because already we have applied the formulas here. Let me show you one more. So in this way you can easily identify like how much days will be the outstanding days for collecting your payments. So it is the 10, and it is definitely a good number because it is less than the limit, that is the 45. So this is a good number. We'll be collecting our credits, we'll be collecting our amount of the credit sales in the exact time. Now let's see other formulas as well. I'll be explaining one by one, but I just want to show you the formulas so that you'll be understanding like how you can calculate this. If you want to calculate this bad debt percentage of sales, so simply you have to apply the exact formula here, 911 divided by contract revenue, so you can automatically get that. Now let's see what is that 91118. You can see 9118 is our bad debts. Okay, so what is the formula is, simply according to the dimension members we have to apply the formula, and it will automatically calculate the result without wasting any time. So the if I want to know the percentage of bad debt to sales, so I have already applied the formula. I can calculate it for any other member formula as well. So it is 9118 divided by contract revenue, and it will be providing the ratio of the bad debts to sales. Now let's change the figures and see the change. Suppose it is apart from 80,000, it is 1,80,000. You can see the days sales outstanding becomes 23. Still it is less than the limit, so it is good. If it is 8,50,000, suppose, now let's see what will be the result. So if it is if the account receivable is more than the contract revenue, so the result will be negative because the days sales outstanding is exceeding the limit, that is 45. So you can understand that the credit sales, the amount of credit sales will be recovered within or more than 106 days. So it is a bad DSO. So in this way you can identify that. Now let's move to the another driver. The another driver is days sales of inventory, or you can also say that um, days in inventory. Let me show you the formula first. These are simply the balance sheet drivers. So here I have applied the formula. Days in inventory is 14,000 by 52,000 multiplied by 365. So why I used this? Let me show you again. $14,000 is my inventory. You can see 14,000 is the inventory, and the 52,000 is my materials. Okay, the cost of the total materials. So the inventory will be divided by the materials. So it will provide the number of days of inventory, or we can say the days sales of inventory. So what is the actual use of that? In general, it is saying that a financial ratio that indicates the average time in days that a company takes to turn its inventory, including goods that are a work in progress, into sales. For more better understanding, I've written here the days sales of inventory, that is DSI, is a financial ratio that indicates the average time in days that a company takes to turn its inventory, including goods that are a work in progress, into sales. Or DSI is also known as the average of inventory, days inventory outstanding, that is DIO, and days in inventory. These are the further terminologies for that. DII, so days sales in inventory or days inventory, we can say anything, and is interpreted in multiple ways. Indicating the liquidity of the inventory, the figure represents how many days a company's current stock of inventory will last. We just want to know, like, whatever the inventory we have procured, so how like what will be the days we can get the stock of inventory, it will last. Okay, so generally it is very important for a company to know, because some items are perishable, and if the company's owner wants to know, like, what is the exact number of days my inventory will last in my stock, so you can identify with the help of DSI if you applied the formula correctly. Generally, we can say a lower DSI is preferred as it indicates a shorter duration to clear off the inventory. Though the average DSI varies from one industry to another, it will depend on the type of the industry, because material will also depend on the type of the industry. But generally, it is saying that it is DSI is preferred as it indicates a shorter duration to clear off the inventory. Now, how we can calculate that? So days sales of inventory, that is DSI, will be calculated by average inventory divided by COGS into 365 days. So here COGS means cost of goods sold. We all very much aware about that. What is the meaning of cost of goods sold? Whatever the amount of the goods we are selling to our customers, the exact terminology is cost of goods sold, and we can also see the cost of sales to this. And the average inventory, we have we are already aware with this. So what we will be doing for calculating the DSI is average inventory divided by cost of goods sold into 365 days, because here we are calculating it for the whole year. That is why we are using 365 days. So where DSI means the days sales of inventory, COGS is cost of goods sold, and average inventory. Now let's understand with the help of one example. Again, if you want to know how you calculate the average inventory, so average inventory is generally, we can say, the ending inventory, or average inventory can be calculated with the formula for beginning inventory plus ending inventory divided by 2. This is the way you can calculate the average inventory if you don't have the average inventory, and this COGS value remains the same in both the versions. Now let's understand again with the help of Excel. So here my inventory is 14,000. So I'll be directly putting the value here. I'm selecting the inventory, and 52,000 is my contract revenue. You can see the formula, days in inventory is equals to, it should always be written in this manner, inverted commas, days in inventory is equals to 14,000 by 52,000 multiplied by 365. So our materials is 52,000. Here in my formula, in place of the whole cost of goods sold, I have taken only the total cost of materials, right? And in place of the average inventory, I have applied simply the inventory. So inventory will be divided by the material into 365. So it will be calculating the days in inventory. It is prepared according to my application requirement. One thing, one more thing we have to select here. What we want to calculate, this is the days in inventory. I have entered the data in the financial year 23. So let's apply that. And rather than plan, I'm using here the forecasting. Also, we can select the actual, because here my data till August, I have selected the data for actual. Now we have to apply the values over here, so it will calculate the total inventory, and here also for calculating the material. So quickly I'm entering the values for getting a result. I'm just using the random values for checking whether the formula is working or not. So 4,95,000 is my total inventory, and my material will be so with the help of formula you can see that my days in inventory is auto calculated as 218. Okay, so it will be depending upon the industry to industry, like how much it should be the exactly the days in inventory. But we have understood why we have understood that why we are calculating, because the days sales of inventory is a financial ratio that indicates the average time in days that a company takes to turn its inventory, including goods that are work in progress, into sales. Because currently my material is keeping in my stock, and we are just we will be going to use in the work in progress for making our products for sales. So why we are calculating this, we are understood this. And DSI is also known as the average of inventory and days inventory outstanding, days inventory, days sales in inventory. Okay, so in this way we can get that. Submit data and refresh. So this is the formula for that. You can apply your formula according to your members in the application. In my application there is not the opening inventory and closing inventory is provided, so I have directly applied the inventory amount. And apart from average inventory, I have taken the inventory amount, and rather than COGS, that is the cost of goods sold, I have taken the material cost. Okay, so in that way it is calculated the value like that. I can show you the exact value by applying the formula here also. Equal to inventory divided by a material multiply by 365, you can get the exact amount, that is 218.4703, and here it is exactly the same. So this is the way you can calculate it that. Now let's move to the another driver. So we have covered the DSO, days in inventory. Now let's move to the bad debts, percentage of sales. Till then it is showing the formula. uh, let's understand the concept of that. So what is the meaning of bad debts percentage of sales, and what is the actual use of that here? So generally bad debts, we all understand that what is a bad debt. Bad debt is defined as the outstanding amounts from customers or debtors that a business deems uncollectible, resulting in an entry known as a charge off. Sometimes we offer the credit sales to few customers, but the customers are not able to pay the amount on the relevant time, and in that case they are simply known as the bad debts because they are unable to pay the debts. Okay, so we can also say that bad debts represent the financial loss that a business incurs when a customer fails to repay credit or outstanding balances. This can happen due to various reasons. What are the reasons for that? Such as negligence. Some people are not understanding their responsibilities. They are simply neglecting dues. And other reasons is financial crisis. Some people are in financial crisis, so they are unable to pay their debts, so they become the bad debts for the company, or the bankruptcy, one and the same thing. So though it's a natural risk associated with extending credit, it needs to be tracked regularly, right? Because for the company it is a financial loss, as excessively bad debt can weaken a company's financial standing. If I'm a company and I'm not getting the pays dues on time, and my bad debts are increasing day by day, so it will show a weakness for my company in my financial reporting. So that's why it is written over here that it needs to be tracked regularly, as excessive bad debts, if the bad debts is excessive, it can weaken a company's financial standing. During tax time, businesses can write off bad debts credits when we are calculating the taxes. So businesses generally, what they are doing, they are writing off the bad debt credits, reflecting the uncollectible nature of these outstanding payments, right? In With the help of this diagram, you can understand the primary reasons for a high bad debt rate. It is due to the lack of real time credit health visibility, okay, then reactive collection process, then manual invoicing, and not offering early payer discount. So these are the few common reasons which a company is not actually following, and they are getting or increasing the bad debts. Sometimes they are not offering the early payer discount, and sometimes they are just maintaining the manual invoicing, they are not maintaining any system records, and then lack of real time credit health visibility, then reactive collection process. So these are the few reasons for that. Now let's understand the concept in a more detailed way, why we are calculating here the bad debt ratio. So the bad debt ratio measures the amount of money a company has to write off as a bad debt expense compared to its net sales. To calculate it, divide the amount of bad debts by the total account receivables for a period and multiply by 100. In other words, it tells you what percentage of sales profit a company losses to unpaid invoices. A high bad debt ratio can indicate that a company's credit and collection policies are too low, um, or it may suggest that the company is having trouble collecting customers' payment. Within B2B businesses, relying on the credit model to bring in more clients and sales volume. So, bad debt has become an inevitable part of operations. In Europe and North America, Non-collectible written off revenues had risen to 2% before the pandemic, says says a MC can say article. It is a worrisome sign if the bad debt rate, the ratio of bad debt and account receivable in a year is too high on the surface. The reason behind it might seem to be limited only to the client, but how a company handles its account receivable also plays an important role. So let's understand with the help of one example. Suppose the bad debts to sales ratio. I have written this example for make you people understand the situation, for make you people to understand the scenario exactly. So the bad debts to sales ratio represents the fraction of uncollectible accounts receivables in a year compared to total sales. Here what is the measure of comparison? We are comparing to total sales. For example, if a company's revenue is $1 lakh and it's unable to collect $3,000, the bad debt to sales ratio is, in that case, the bad debt to sales ratio is what is unable to collect, that is, our bad debt is 3,000 divided by the total revenue of the company, that is 1 lakh. So here 0.03 is my bad debt to sales ratio. This metric provides valuable insights into a business cash flow, the efficiency of its AR and collection process, and overall financial health by closely monitoring the bad debt to sales ratio. So you now you might now you might understand that why we are calculating the bad debt to sales ratio. Your business can formulate better credit terms, reduce uncollectible account receivable, and maintain a healthy cash flow. I have also attached this example to make you people more clearly understand. Let's say company X make 5 lakh dollar in sales in a year, and it is unable to collect 20,000 among those 5 lakh. So you can understand that bad debts is 20,000, total sales is 5 lakh. So for 20,000 will be divided by 5 lakh. So my bad debt to sales ratio is 0.04, or we can say 4%. So in this way you can calculate that. And if you see this, I have applied the formula, but I don't know why it is not showing. Let me refresh this. Maybe someone has removed the application. I have written the formula here also, which I have applied on my application, the member formula. These are the ratio formulas which we will be going to discuss soon. Yeah, here it is. So my bad debts formula is 9,118 divided by contract revenue. Okay, so in this way it is calculated. I have applied the screenshot as well. Let me check what is this 83820. So you can see here what is happening here. Yeah, so here 83820 is bad debt expense. Okay, and contract revenue, it is divided by the total sales. In place of total sales, here I took the contract revenue. So in this way it will be calculated that. Now let's again connect to the smart view and get the exact value. So what numbers are required here? 83820. Bad debts expense. Contract revenue. It will be found under SG&A. Here it is. Here I have selected the actual scenario and the financial year 22, and the data is already in my application, so it is providing this value automatically. We can change it as well for more clearly understanding. Let's change the figures quickly. Suppose among those 11 lakh 45,000, there is a loss of 1 lakh 50,000. So let's see what will be the bad debts percentage of sales. It is not calculating. Let's check the formula again. Triple 118 divided by contract revenue it is using. Okay, we have to select bad debts for identifying the exact figure. It will come under the other expense income. Under the income statement. Here it is. Suppose bad debts is 1,50,000. Now let's see whether it is calculated or not. Refresh. It is showing 0. I think some error is here because my formula is correct. 9,118 is bad debts. Let's again check the member formula. Yeah, formula is correct. 9,118 is our bad debts divided by contract revenue, so it should be calculated. Why it is 0? Let's change the figures. Okay, so something went wrong because here it is calculated when we applied the formula. Okay, for the day sales outstanding as well as for the days in inventory, but I have to check that why it is not calculating that. Maybe due to the network error, it is not showing the exact result. So I'll be checking that after this session and will let you know what is the problem here. Now let's see what are the other drivers remaining. So we have covered bad debts in days in inventory. DSO is done, bad debts is done, days in inventory done. So you can now understand that how we will be calculating these balance sheet drivers, and once you calculated all these, only accrued payroll and prepaid is and DPO is left. I'll be discussing that also, but let me show you that in the form. 。 . 。  . 。 . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . 。 . 。 . 。 . 。 . 。 . 。 . 。 . let's do one more thing. Here let's change the from actual to forecasting or plan. My Excel has been crashed. Wait for a second. I've saved the file. It is taking too much time in connecting with the server. Nine triple 118. Okay, something is wrong here because it is still not calculating the bad debts percentage to sales. Okay, let me check it. Now let's move to the another one. So as you understand that how we can apply the formula for calculating the members exactly for the balance sheet drivers. Now let's quickly move to the other concepts. If we talk about the accrued payroll, so it is an accounting method that tracks debts or accrued liabilities instead of tracking expenses once you have processed them. So accrued payroll includes expenses or debits that are still pending. Including these pending expenses gives you a more accurate understanding of the money flow in each pay period. The business term for its debit is current liabilities. Current liabilities might include invoices from independent contractors, uncashed paychecks, pending credit charges from expense accounts, and other forecasted payroll. Like any type of payroll, accrued payroll accounts for all types of compensation, not just gross wages. This includes salary or hourly wages, commissions and bonuses, paid time off, payroll taxes and employee benefits. And accrued payroll helps business owners and payroll managers to think in terms of what do we owe rather than how much got taken out of the account. With this approach, you can better allocate business costs and avoid unexpected payments, which will help you invest resources into company development and growth more confidently. So that is why we are using it in the balance sheet drivers. And if we talk about the accrued payroll, so it helps businesses owners and payroll managers to think in terms of what do we owe rather than how much got take out of the account. And what is the alternative to payroll accrual? So the alternative to payroll accrual is cash accounting. Why? Because cash accounting is a form of accounting in which transactions only get recorded upon cash coming in or out. It is simpler than the accrual method but shows a lagging incomplete picture of the company's financial standing. If we talk about the formula for that, so let me move to the application, and here it is my accrued payroll expenses. Let's check whether my formula is reflecting here or not. The alias is accrued payroll percentage of employee expenses. So here it is my formula. Accrued payroll expenses is 21,000 divided by 60,000. Let's check what is the 21,000 member here. So you can see that 21,000 is my accrued expenses, and 60,000 is my operating cost. So my accrued expenses will be divided by the total operating cost. I think there is some network error because it is not showing the formula exactly and not calculating the formula as well. But you people might understand that what we are exactly doing here. Okay, so accrued payroll expenses will how it will be calculated. Accrued expenses divided by the total operating expenses, and let's check this in the smart way as well. Here I am just changing the account members, rest will be same. Okay, it is operating cost. There are various members under that, so I am simply removing that. We are just using few members for the testing purpose. Okay. um Let's suppose 20,000, 40,000. Oh no, again it is crashed. You can see it is automatically calculating the accrued payroll expenses of employee expenses, that is 83%. Because what we have done, we have simply entered the accrued expenses and we have entered the operating cost over here. So it has automatically calculated the accrued payroll percentage of employee expenses because we have applied the member formula over here. So this is the way you can calculate the balance sheet drivers. Now let's check that in the data form, that how you can create the data form for that. Here are my driver data form. The balance sheets drivers plan. Actually here in the layout I have selected the financial year 24. That is why maybe the value is not showing over here, but let's check. Yeah, we have entered few data in that, so it is calculating the DSO, that is 10. Okay, now let's change the financial year in this scenario and check the value. If I want to check it for my historical data, so what value it provides over my data form. See this, my accrued payroll expenses is showing over here because when I calculated my accrued payroll expenses, so I selected the actual data, my historical data. So we can do it for the plan forecasting, and if we want to check for the historical data, so we can do that as well. So this is the beauty of this. And you can see I have selected each and every member of my balance sheet drivers over here. That is the days sales outstanding, then bad debts, then days in inventory, then prepaid expenses percentage over operating expenses, then DPO and number of days, and accrued payroll expenses. So we can fill the data, whole data as well. If I take the 23, then let's see what will happen. Okay, so my days in inventory was calculated for the financial year 23, so it is 218. So in this way you can prepare the data form. Simply I have selected few things from my point of view, and on the page I have selected the year. You can keep this on the point of view as well, POV. And in my rows I have selected the balance sheet drivers. From here you can select that. See this, and here I have selected the total year total. So this is the way how we can do that. Actually today I just want to complete the two requirements, but one requirement was only one requirement we have completed. We have checked the balance sheet drivers, we have understood the dimension members, and we have understood the data form as well, with the concepts and the corresponding formulas, member formulas we have checked that. Now the ratio accounts we will be covering in the next session, dimension members and the corresponding formula and data form. So this is also the same. I have already prepared my ratio. Wait for a minute. Yeah, here you can see that this is also same. We have applied formulas, but one thing we have to do, we have to understand the concept why we are using that. Okay, and it is also similar in the dimension. In the member I have to enter the formula, the exact formula, like if I want to calculate the current ratio, so it will be current assets divided by current liabilities. So you can see here I have selected the relevant members, and it will automatically giving me the exact current ratio. Similarly, if I want to calculate the working capital, so it will be current assets minus current liabilities. You all are very well aware about that. So in this way we can calculate that. So in the tomorrow's session we will be covering this, the ratios data form. I will show you how I created my data form for the ratios. You can see over here I have prepared for the leverage ratios, liquidity ratios and profit performance ratios. But I think it is already too much we have covered today. So for not getting exhausted, I'm just ending this session. If you have any kind of doubts, you can always feel free to ask. And in the tomorrow's session I will be covering this requirement. So thank you and have a nice day.